Hello everyone, you're watching Trading Algorithm, I'm Vlad. In this video I will show you indicators that will help even novice traders to read the tape, identify logical patterns of buyers and sellers' behavior and predict further price behavior. In the previous video we talked about the basics of price action. The link to it is in the description of this video. If you haven't watched it, then watch it first, as it is a logical continuation of the previous video. One of the most popular questions is how to find a big player to trade with. The easiest way is to look for high volume trading. This is a good indicator, but nowadays many advanced large traders or firms use robots. These robots are able to split large volumes, and small volumes will be visible in the feed, but there may be large players behind them. In addition to the size of the trades executed, several other parameters are important, such as speed and number of trades. Therefore, it is important to analyze trading intensity as an indicator of trading robot activity, and robot activity is an indicator of large participants' interest in current market prices. On the slide you can see the aggressive trading patterns indicator in action on the tick chart. The purpose of the indicator is to find places with intensive trading. Let's take an example. The price of Bitcoin futures was in a downtrend, and on the left you can see the downward momentum of the trend. Now let's look at what happened after the price stopped falling and corrected upwards. On the left is a screenshot from the print feed of the highlighted area of price growth. On the right there are two growing candlesticks from the cluster chart up to the blue rectangle. The band shows normal trading from a logical point of view. Selling is mixed with buying. Buying is slightly dominant, i.e. there are more of them and the price is rising, which means there is not much resistance for buyers in the cup. At the top of the corrective movement, buy orders of various sizes appear intensively in the print feed within a few seconds. The majority of the purchases are traded within 30 seconds and there is a total dominance of the buyers as there are virtually no red prints. Given the intense dynamics and the location of these trades at the top of the local uptrend, we can assume that the stops have been triggered. It is worth saying a few words about the nature of stop losses. Let's say we are looking for sell stop losses. When you open a sell position, closing the position will always result in a buy. Sell exits can be different types of orders. For example, if you open a sell position and the price goes down, you will close the sell position with a profit, i.e. below the opening price. In this case you will place a buy limit order, which in our situation can be called a take profit, or you will buy back the position with a market order. In this example, after the decline, market buying appears with a clear advantage. Such bursts of buying during a decline can be caused by sellers closing out their sales and buying into the market. And if you have sold and the price has gone up, you will most likely exit with a market order or a stop order, which in this example is a stop loss order. Such an exit is shown in the market by video in the print feed and in the cluster chart. In most cases, this will lead to a price acceleration and the appearance of a volatile candlestick. As you can see, these two situations are fundamentally different because of the place where such buying occurred. Therefore, in the left example, the buying can be an exit of smart money from a selling position, but it can also be an entry into a buying position at a good price, as it occurs after a decline, i.e. at a better price than the previous buying price. In the right example, the appearance of purchases is likely to be associated with the triggering of stop losses in the form of buy stop orders, which when triggered, accelerate the market even higher, and can be triggered by a domino effect as stop orders at the previous level push the price up and are hit by a new portion of stop losses, and so on. The result is a cumulative effect, and the price makes a sharp jump until the sell limit orders appear, which execute all the stop losses. This is the main reason why stop losses can often be executed at a worse price than they were set, especially if the stop loss is in a cluster with other stop losses in the same price range. Let's go back to our example where the price has risen in a correction after a trend decline. After the price has finished rising, we can see a significant intensification of trading and a total dominance of buying in the pressure feed. Simply put, after the rise, a lot of buying was triggered in the market, including large buying, which can be identified as the destruction of sellers' stop losses. It is likely that this spike in buying included not only sellers' stop losses but also late buyers who bought at the worst possible price. After this spike, the price stopped moving higher, suggesting that the initiative was exhausted. All these factors suggest that the correction is likely to end and the price will resume its decline. After the aggressive trading pattern indicator showed a signal for possible stops, the price tried to move higher several times, but to no avail. A strong buyer did not support the movement and the price moved to the downward phase. Thus, using this indicator you can analyze the pressure band more easily and get the places of probable stops and reversals on the chart. The indicator will create blocks in places where there is intense trading, and by looking at the place where they appeared, we can assume whether they were most likely stop losses or a counter-trend attempt to reverse the trend. And by waiting for the price to react, you will get a support or resistance zone to trade on its test. It's worth noting that strong moves are often accompanied by multiple stop-loss moves, indicating an imminent price stop. In the case of a strong level break or a transition to a trend phase on a larger time frame, there can be many more such intensifications than the two you see in this example. On the left there are two bullish tops and on the right there are two strong bearish tops. Therefore, it is worth combining the analysis of spikes with the overall market analysis to understand what is happening in more detail. For example, to increase the chances of a successful trade and good movement potential, it is interesting to track such spikes when testing strong resistance zones on the older time frame. In this video I will not go into the details of the setups, we will do that in a separate video or individually, as it takes a lot of time. The aim here is to show you what you can see on the chart with this indicator. The next indicator, Order Flow Analytics, is more suitable for scalpers who need to find an entry point with a small stop loss. This indicator generates a lot of signals, so it should be used in conjunction with levels or zones where a price rebound is expected. It consists of a lower histogram and blocks of levels and arrows. Let me first say a few words about the market microstructure. In the example you can see the second chart of oil for a period of 5 minutes. This means that the basic structure of all movements consists of balances in the pressure band and imbalances caused by the aggressive side, i.e. market selling. As you can see, in 5 minutes oil has gone through two full-fledged micro-trends, consisting of the micro-imbalances we talked about at the beginning. And when the buyer's initiative ends, the seller's initiative appears on the market, which turns the price around, forming new balances and imbalances of the downtrend. This indicator was created to find the microaggressions of buyers and sellers. It shows the initiative of a buyer or seller, highlighted by blocks of green and red. The histogram also shows a lack of initiative when buyers or sellers fail to move forward for a long period of time. In this example we will analyze several situations when testing the resistance zone. We'll be looking for a pattern that I call the initiative intercept. This pattern should show us the moment when one party takes control of the price from the other. On the left side of the candlestick chart we see a support zone that has been broken from top to bottom and is now acting as resistance. When the price approaches this level, we see a green spike on the histogram and a green border on the chart. The prints on the left are unremarkable trades with no clear advantage for either side. However, the indicator shows that there is buying aggression. After a brief pause, the band on the right shows how the sellers began to dominate. A red block appeared on the Order Flow Analytics indicator. At this point we understand that the sellers have started to take the initiative, the price has started to move under the pressure of the sellers and this is an ideal place to enter. After a while, the price starts to test our resistance zone again. As the price approaches the level, there are no obvious signs of the buyer's advantage in the news, but the indicator shows the seller's aggression. Now we need to see the interception of the initiative. In the pressure feed we see the dominance of the sellers in a red block, which will be our signal to act. As I said, this tool is primarily designed to catch small bounces, so don't expect positional moves on every signal. Let's take a look at the third resistance zone test. As we approach the zone, we see a familiar picture in the pressure band, with buyer's aggression in the green blocks on the chart. However, after the test of the resistance zone, no aggressive sellers appear. This can be seen in the lower histogram, where there are no sellers surges. The price then breaks through the level without much effort, as there is no resistance in the form of limit selling. The price then consolidates higher and returns to the top-down test of the broken zone. At this point, there is seller aggression, which is an attempt to return below the broken zone, but ultimately does not result in a move below the zone. This is followed by buyer pressure and the price continues to move towards the breakout. If you have a trend detection system like mine, you can look for entry points in a predefined direction along the trend. You do this by tracking the activity of buyers or sellers at the time you need. You need to track the aggression of buyers in an uptrend at the end of microcorrections to the downside. This indicator has an additional filter level that gives you signals when it breaks through. This allows you to look for signals on the exits of upward corrections. For example, you have a tool to identify a trend. I will use my dynamic channel indicator with pivot points at the breakout of the channel. If we get an arrow-shaped signal of a new trend and want to enter with low risk and good potential, we can turn on the analytics flow order to look for buy signals. We should ignore all sell signals so as not to trade against the trend. Now you will follow the aggression in the end of micro corrections. The signals will appear on the breakdown of volume levels from bottom to top to look for signals at the exits of the corrections. In this case, for example, on Euro futures, the stop loss for these signals was between $37 and $50 per contract, and the potential for movement was many times greater, giving these signals an advantage. Let's move on to analyzing individual prints in the feed. Previously we looked at the intensity of trading, the aggression of the buyers or sellers, i.e. analyzing whole blocks of prints. Munsun can detect filtered buying or selling and, based on the price reaction, identify potential reversal points, traps for traders. I used the same zones as in the previous example. During the testing of the zone, there were purchases that ultimately failed to break through the zone, after which the price began to move downwards and we received a signal of a buyer's trap. The next time the resistance zone was tested, there was buying that failed to break through the level. I used the arrows to show where the purchases were on the chart, highlighted in the printer ribbon. After they appeared, the price went down and we got a signal about the trap the buyers had fallen into. By setting the necessary filter, you can only catch the actions of extremely large trades, which are definitely the work of large traders. There will not be many such trades, but you will be sure that they belong to someone important. This is the end of the review of the 3 indicators. I hope you liked them and found them useful. If so, follow the link and find out the details of how to get them in the Trading Algorithm Telegram bot. The next video will focus on market structure analysis. This is the first step in analyzing charts to understand the current state of the market. Please support this video by reposting and liking it, writing a comment. You know that it helps YouTube to promote this video. See you in the next video.